Many of you have been asking me about this video, and I figure I might as well do it now since I learned a lot after filing my taxes this year. Many people ask or want to know how dividends or distributions are taxed in a regular cash account or non-registered account. I covered the TFSA and RRSP in part 1 of this series, so make sure to check it out if you haven't seen it yet. Now, I can't promise you that every single thing that I'll say in this video is 100% accurate, okay? I'm not a certified accountant by any means, but I've done enough research and have enough investing experience to give you a pretty good idea on how taxes work in Canada for a regular cash account. So here are some of the questions that I will answer in this video. How are dividends taxed in a cash account? What are the different sources of income and how are each of them taxed? How are high yield funds that I discuss on my channel taxed? I'm talking about split funds, income funds here. Another question, how are REITs taxed, real estate investment trusts? How is foreign income like US dividends taxed? How does the 15% withholding tax work in a regular cash account? Let's get started. The first thing I want to cover is how different sources of income are taxed. This is important because it will answer a lot of questions right off the bat. Also, once you understand the 4 different sources of income and how each of them are taxed, it's much easier to answer the most common questions people have, and which I mentioned a few seconds ago in the intro. So it took me a really long time to research all of this, but a lot of clarity came when I was researching ROC, or return of capital, because I found a really good document that visually compares different sources of income and how they are taxed all next to each other using $100 as an example. So let's go through this document real quick and check it out. Of course, I will put the link to this document in the video description below if ever you want to read it fully yourself. So let's check it out. So here's the document I want to show you guys. A very cool document. It's actually written by TD, and the premise of the document is really to explain how return of capital, or ROC, works. So I strongly suggest you check it out, but it's not necessarily, I'm not talking about ROC here necessarily, it's just a small portion of it. What I really want to bring your attention to is this graph here. This is what really helped me visually understand the different sources of income. So first of all, I just want to start by saying this is a typical scenario for someone in Ontario that has a 49.53% marginal income tax rate. So of course, it's not going to be 100% accurate, guys. If you're in Quebec, if you're in BC, it's going to be different. It's also different from each person because our marginal income tax rates are all different. But this gives you a good idea of a typical scenario, okay? So take it with a grain of salt, but it really shows the different sources of income. So as you can see here, this is with a $100 investment income. So if you get $100, how much money do you get to keep and how much money do you lose because of taxes? So the green amount is what you get to keep and the black amount is what you lose out in taxes. So the worst form of income that investments could give you is interest income. Okay, that is the worst because like you could see here, you lose about half your money or in taxes. So you get taxed, half of it is gone. So interest income, salary income would fall under here. Non-eligible dividends or foreign dividends like US dividends would also fall under here. So this is really the worst category. The second worst are dividends for us Canadians. These are eligible dividends. So dividends from a Canadian corporation like Enbridge, CIBC, Bell, etc., etc. As you can see here, it's taxed. You get to keep $16 more than the interest. So it's taxed about 15 to 16% better than interest income. The second best source of investment income is capital gain. So if you make $100 of capital gain income, you get to keep $75 out of 100. So it's much better than interest and also better than eligible dividends as well. So capital gains could be basically when you buy low and sell high, right? You make a capital gain. This is the category it would fall under. Now, the last one that's taxed the best is return of capital or ROC income. This is 100% non-taxable. So you $100 of ROC, you get to keep $100. This is not taxed at all. So here is the visual, guys. Now that you could visualize this and understand how there's 4 different sources of income, It says GIC here, by the way. Just wanted to point that out because GICs give interest income. Those are, the crappy little granny investment things that banks give you. I'll give you 2% if over 5 years or something like that. Completely ridiculous. The GICs also fall under interest. So just wanted to point that out. But these are basically the 4 sources of income. Once you visualize and understand this, you will understand a lot about what I'm about to talk about next. So there you have it, guys. I hope this document gave you some clarity like it gave me when I first saw it. From this document, we could clearly see that there's basically 4 classifications when it comes to different sources of income. The first one is really the worst one, and this is where ordinary income and interest income falls under. So we're talking about salary here, non-eligible dividends like US dividends, and of course, interest income. So interest is what you typically get with bonds, things like government bonds or corporate bonds. So it's just another reason why I hate bonds and fixed income altogether in the first place. Not only is the income dismal, it's lower than equities or stocks, but it's also taxed the worst. So why would you ever invest in such a thing? I don't get it personally. Eligible dividends are next, right? So they are taxed a bit better than regular income, like we just saw, about 15 to 16% better. So the exact calculation is pretty complicated. In Canada, we use, or what we have is a top up or a gross up system. And honestly, I don't even care to fully understand it. I always had it in my head personally that eligible dividends are taxed about 15% better than regular income. And it turns out that I was correct. They are taxed about 15 to 16% better. So it's really all you need to know about how eligible dividends are taxed compared to the first source of income. Now, what about US dividends now if you're Canadian, right? So not only does it fall under the worst category of tax, like interest, but on top of that, there's also a 15% withholding tax on the dividends itself on top of that. So it's pretty bad, right? Pretty insane. Well, that's where the foreign dividend tax credit comes in, because this income is already taxed the worst. So the government provides us a tax credit, the one I just mentioned, to essentially nullify the 15% withholding tax. It's only fair, right? So basically it falls into the first category, and you don't have to worry about the 15% withholding tax, although you will see it come off or come out of your dividend. At the end of the year, you get a 15% foreign tax credit, which essentially balances it out. So in the end, US dividends in a cash account are taxed like regular income or interest income. By the way, you cannot get this foreign dividend tax credit if you hold US stocks in a TFSA. That's because the income is already tax-free. So that is why I hold most of my US funds in my RRSP account. No withholding tax whatsoever, simply because the RRSP is considered a retirement account. All right, so moving on to capital gains now. Capital gains is what you get when you buy a stock low, sell it high. If you make money on it, that's considered a capital gain. But also, when a fund manager or like a covered call ETF sells covered call options, that portion of the income is not considered a dividend, is not considered an interest, it's considered capital gain. So capital gains are taxed even better than eligible dividends. You're able to keep about 75% of it, or $75 out of 100, right? So it's pretty easy to understand why. In Canada, and I believe this is across all provinces, but don't quote me on that, only half of your capital gains are taxed. So the portion that is taxed at about 50%. So that's why with the example, if you make $100 a capital gain, you get to keep $75. Very, very easy. Just think of that you get to keep 75% of your capital gain. As simple as that. This is why, by the way, CEOs, executives get paid primarily with company stock, not salary. So who the heck wants salary income, because it's taxed the worst? So they get paid in company stock, so that when they sell the stock, when they leave or when they quit, it's taxed much better than salary income. Makes complete sense if you ask me. Last but not least is return of capital, or ROC income. This source of income is taxed the best at zero tax on that. Now, of course, getting a ROC income does lower your ACB, or your adjusted cost base of your shares. And I talk a lot about ROC in detail in another video, so make sure to check it out. Many people, and here's the important thing, many people assume that ROC income is bad. It's negative because it's just a fund giving you your money back, like some sort of Ponzi scheme, right? So it's a bunch of nonsense. Just another stupid investing myth, just like high yield equals high risk. Please. So let me quickly explain why. Capital losses is the exact opposite of capital gains, right? Capital losses can be carried forward indefinitely or forever. So if you sell a stock lower than you bought it for and lose, let's say $1,000 with the transaction, you could carry forward that $1,000 loss, capital loss rather, forever. So if in 7 years after that, let's say you sell a stock and make $1,000 capital gain, you made money. Well, you could take that $1,000 capital loss from 7 years ago and essentially nullify your current $1,000 capital gain. So you pay no taxes on it whatsoever, avoiding the tax. Makes sense, right? Stay with me. A covered call ETF like QYLD, ZWC, etc., etc., etc. One of my favorite funds, by the way, type of fund, typically classifies a portion of their income as ROC income. So people automatically assume it's just my money coming back to me. It's simply not true, guys. The reality is that funds can also, because they're considered corporations, they could also carry forward losses indefinitely. So guess what covered call income is classified? Like I mentioned before, it's not dividend, it's not interest income, it's capital gain income. So a fund manager can use losses from years ago, apply it to the capital gains that they made by selling covered call options that year, and magically transform the capital gain into a ROC. So the income is still there. They still made money and paid it out to us, but they offset it using losses from a previous period. So the portion of the income that they give us, it becomes ROC income. So thank you, fund manager. You made my income much more tax efficient in my cash account. The fact that most people think ROC is bad just drives me crazy. In all honesty, if you're a buy and hold investor who does not intend to sell any shares, ROC income is the best for two reasons. The first one is pretty obvious. There's no tax whatsoever to pay on that income source. The second is if you hold a fund for a really, really long time, we're talking 15, 20, 30 years even, it's very possible and pretty likely actually that your ACB, or your adjusted cost base, goes to zero, right? So think about it. Let's say you have a fund that gives you 10% yield every year and it's all ROC income. Well, after 10 years, that makes 100%. So your average share price or your adjusted cost base would go to zero. This means two things. Number one, if you sell the shares and the total value of the sale is $10,000, well, you just made $10,000 of capital gain. So the whole amount will be taxed as if you bought the stock at $0 a share, basically. So luckily for you, if that happens, capital gains are taxed pretty good. So you get to keep about 75% of it. Not bad at all. Number two, if you decide to keep your shares anyway and your ACB hits zero, so this is typical if you're a buy and hold investor. That's what you should be doing, by the way. Any ROC income that the fund pays out after that, once your ACB is zero, is automatically considered capital gain income for you. So technically, you will have to pay taxes on any ROC income that comes your way at that point, once your ACB hits zero. But once again, it will be considered capital gain income, which is the best scenario possible as it's taxed second best. Better than interest, better than dividends. Just another advantage of being a buy and hold passive income investor. Okay, so hopefully now you understand the different sources of income and how each one is taxed. Very important to understand that before we move on. So eligible dividends, right? Pretty straightforward. They're all taxed the same. So eligible dividends is what you get if you have single stocks, if you own the stocks individually, a Bell or a TELUS, Emera, Enbridge, CIBC, right? The typical mainstream way that most people invest is by buying these single dividend stocks. So you would be getting eligible dividend income if you had that. But what about ETFs? What about covered call ETFs or split funds or income funds or even REITs? How are they taxed? Well, the answer is it's different for each fund. I wish I had a simpler answer, but that's the truth. And the reason is pretty simple to understand if you think about it. Each fund has its own combination of the four income sources we discussed. So don't forget there's four sources like we saw from that sheet. So because each fund has a different combination of these sources, they are all taxed differently, including REITs, by the way. So how can you find out? Where do you look to find the breakdown on the income source of a particular fund, whether it's an ETF, income fund, split fund, or a REIT? Well, there's really two ways, guys. Number one, you need to find the tax info on the fund's website. I showed this in one of my previous videos, but I forgot which one. Maybe it was the rock video, but I'll show you again right now. It's really easy to find. And now that you understand the four different sources of income, you will understand exactly what you're looking at when you're looking at the breakdown. So I will show you a few examples in just a minute. So don't worry, very easy to find. But the second way or the second method is by looking at your annual T3 statement that your broker provides you for each fund that you own. Because since each fund is unique in terms of which sources of income it has, you will get one T3 statement per fund. So eligible dividends, you only get one statement called a T5 statement. For all your eligible dividends, you get it all in one statement because, like I mentioned before, it's all taxed under the same tax umbrella, the eligible dividend tax umbrella. So they're all taxed at the same rate. So let's check out a few examples of what I was talking about so you could easily see how easy it is to really hunt down and find the breakdown of each of the funds that you want to investigate. All right, guys, so let's quickly check out 7 examples, okay? I'm going to show you 7 examples, and I promise you that now that you understand how the different sources of income works, you will understand exactly what you're seeing here. So let's start with ZWC. This is a covered call ETF in Canada that focuses all on Canadian dividend stocks, right? So all you got to do is click on tax and distributions. You select 2020. You can't see the breakdown of 2021 until the whole year is done, right? So we'll go back to 2020 here. And if you go all the way down to the bottom, you could actually see the whole breakdown of the income. So the total dividend per share for 2020 is $1.32 per share. That's the full distributions, every month. So 132 divided by 12 gives you the monthly distribution. So for the whole year, $1.32 per share. And here is the breakdown. So out of the $1.32, 65 cents, or a little less than half, of the income or of that dividend or of that distribution is considered eligible dividends. So this makes sense, right? Because eligible dividends comes from Canadian corporations, so it's obvious that there's going to be a big portion of eligible dividends. Now, the rest or the other half is actually considered return of capital. So this portion, like we mentioned before, you do not pay any taxes on it. So there you go. Here's the breakdown of ZWC, Canadian dividend stocks, right? What about ZWG that has global high dividend stocks? So mostly US stocks in here, but also some Canada and also some Europe. Well, if we go to the 2020 breakdown, the total dividend per share for the year 2020 was $1.76. Let's check out the breakdown. So out of the $1.76, only 8 cents is eligible dividends, and this makes complete sense because there's a very, very small amount of Canadian dividend stocks in this fund. Non-eligible dividends, other income, here we go. Capital gains, 49 cents out of the $1.76 will be considered capital gains, which is taxed better than eligible dividends. 63 cents return of capital, and 62 cents foreign income. So this would pretty much be non-eligible dividends. I don't know why they have non-eligible dividends and foreign income. For me, it's the same umbrella, but there you go. So a portion is foreign income. This is the income from the non-Canadian dividends, a portion is return of capital, a portion is capital gains, and a little portion is eligible dividends. So this is what I mean by every fund, it's different. It's a different combination of the four sources of income. And you also have foreign tax paid. So this is simply that 15% withholding tax that us Canadians have to pay when we have US listed stocks. So because this is a Canadian listed fund, we do not pay the 15% withholding tax. It doesn't come out of our account. It's the fund manager who takes care of it for us. So think of it as it's included in the fund. And here's the proof right here. I got a lot of questions. People ask me, yeah, well, if I have a Canadian listed ETF that has US stocks in it, do I pay the 15% withholding tax? The answer is no. The answer is it's already paid by the fund manager. You could actually see that here. So moving on to another covered call ETF, NXF, that focuses on energy. So mostly, there's no Canadian companies in this one here. And you could see the breakdown right when you click on distributions tab. So for 2020, the total dividend was 42 cents or almost 43 cents. And you could actually see the breakdown here. Capital gains, nothing. Return of capital, well, 36 cents out of the 42 cents is return of capital, and the rest is foreign income. And as you could see here, this one also foreign tax paid. They take care of the paying the 15% withholding tax on the non-Canadian stock. So you don't have to worry about that if it's Canadian listed, if the ETF is on the Canadian stock market. So here's the combination for NXF, and you can actually see the different combinations as you go back in time throughout the years, right? Now, this one in particular is interesting. You could see here that it's always had capital gains throughout the years, but in 2020 it has no capital gains but all return of capital. This makes perfect sense because 2020 was a horrible year for the oil and gas industry, so there's a lot of losses. So what this fund manager did was offset the capital gains income, which is income you get from the covered calls, and turned it into ROC. So that just proves that what I'm saying is true here. Let's go to a split fund, Dividend 15, one of my favorite split funds of all time. If you go to fund documents, you will find it right here, tax information for the Class A share. You open up this document, and they haven't populated the whole thing for each single dividend in 2020, but they've done it for the first 8. So as you can see, the breakdown is right here. So it's very easy, right? Because this one is 10 cents a month. So out of the 10 cents, the biggest portion, or 9 cents, it will be classified as eligible dividends, and the rest is capital gains. So no return of capital for this one this year. So there's another example. Let's go to Canoe EIT. This is a closed-end fund. Where do we find the information? Right on their website. All you got to do is click here, tax information, and you actually have the distribution breakdown for 2020. So out of the whole distribution or the dividend for the year, 4%, very low amount, will be considered eligible dividends. 53%, the majority, it will be considered capital gains, and 42% return of capital. So here's the combination for Canoe EIT, one of my favorite, if not my favorite, closed-end fund. What about REITs? Well, REITs, most people think that it's considered ordinary income or foreign income, right? The worst form of income. It's simply not true. Look at True North Commercial REIT. If we actually open the 2020 Statement of Income Trust, so once again, it looks like the Dividend 15 one, but if you actually look at it, you could see that the whole distribution, all, it's almost 5 cents a month, is all considered return of capital. The whole thing is return of capital for the whole year. So people who think REIT income is taxed the worst, it's taxed like ordinary income, it's not true. The answer is it depends on the REIT. You got to check it out one by one. Let's look at Ryokan, for example. Ryokan in 2020, 60% of their distribution is considered other incomes, which is the worst form of income, or the worst taxed one. But 17% is considered capital gain, and 22% return of capital. So there you go, guys. Here's just a bunch of examples just to show you the different combination. Each fund or each REIT or each split fund has a different combination of the different sources of income. So it's by investigating it one by one, or checking out your T3 statement at the end of the year for each fund, where you will really get your answer on how each fund is taxed. So if I can basically summarize what we learned today in this video, which took me a really long time to do, all the years of research put in one video, I tried to do my best to explain it properly. The funds that I preach about the most, split funds, income funds, covered call ETFs, they're much more tax efficient than regular dividend income or from owning the single stocks. Eat that, mainstream dividend investors who only buy single stocks. Not only do they get less yield typically, but they pay higher taxes. Just another advantage of being a passive income investor that's really hunts down income instead of growth. Of course, if you have the investments in a TFSA or RRSP account, none of the info I really talked about in this video really matters because the income you get is all tax-free in those two accounts because they're registered accounts. Yes, I know when you withdraw money later on from your RRSP, you need to pay taxes on it, but that's a whole different story, which I won't get into now. The TFSA, 100% tax-free anytime. That's why I always say it's the biggest gift the government, Canadian government would always give you is the TFSA account. So hopefully you now understand how taxes work in a cash account. I tried to explain it best I could in the proper order. Was this video helpful? Did I confuse you even more? Please leave me a comment below or let me know if something is not clear. As always, please support me. Please support this channel by hitting that like button. It's free for you. It helps the channel grow, so it's a win-win. Also, make sure to check out our website, guys, passiveincomeinvesting.ca to really access my digital product, the Ultimate Dividend Passive Income Investing package. All the years of research into the best income and growth stocks, all in that package or in those spreadsheets. So it's really all the stocks you need to build your own portfolio. Comes with lifetime updates, so you only need to buy it once in case a new version comes out. And also you could book a one-on-one live video consultation with me personally if ever you want me to review your portfolio, help you build a portfolio, or answer any of your questions. I'll be more than happy to do that. Very easy to book an appointment, guys. It's right on the homepage. There's a giant calendar. You just got to find an open date and book the appointment. Finally, make sure you're subscribed, guys, so you don't miss out on our future content, our future community posts on passive income investing, all really designed to help you on your investing journey. We're also on Instagram. We're also on Facebook. Our Facebook group is growing rapidly. We're at over 300 members now, which is great. So please join our community there if you use Facebook. Our mission remains the same, guys. It's to help everyday working people invest on their own to build their own stream of passive income so they can enhance their quality of life. So with that, take care, guys. Stay safe, of course, and see you next time.